Consumers are spending more than 11% of their disposable income on food these days. That's the most in 30 years, according to the latest data from the USDA. Joining us right now to talk about the impact of food inflation on consumers and what it means for retailers as well is Simeon Gutman. He is Morgan Stanley's U.S. retail analyst. And Simeon, these numbers are pretty astounding. 11%, that's a huge chunk of consumers' disposable income. What's it mean overall?
Well, it's been elevated for the past couple of years, and actually on an inflationary basis, it was even higher. It's starting to come down. What it means is that we're consuming less units. Units are actually down 4 to 5%. So volume or actual tonnage is down as a result. So we're seeing cutbacks across the board.
Cutbacks where specifically?
In how much we're consuming. Now, it's not isolated to one category. It's across the board. So if you think about the perimeter of the store, the middle of the store, you're seeing units coming down across the board. The units in the middle of the store are probably down a little bit higher than the perimeter. There's some shift towards the outside. Ironically, we saw private label, which you would see consumers naturally gravitate towards. That actually increased all throughout 23 until about the middle of the year. And by the middle of the year, we started to see private label come down, which was a little bit ironic given the shift.
What does this mean just in terms of grocery store sales versus eating out at restaurants? I would assume that people try and cook more meals at home if things are getting more expensive.
We're just starting to see that. So if you take a look at the long-term average of food at home, it used to be at about almost 60%. That shifted over the last couple of decades. It got to as low as 44% a couple months ago. Now we're seeing it start to tick back up to about 46%. So the share of stomach, if you will, is in favor of the restaurant, but it's starting to shift back to food at home, especially in the last 2 months. January, we saw a spike. That spike could have been partially due. There was bad weather, there were storms. I think people were probably forced to eat at their home, but we are starting to see that tick back up. A major restaurant chain even called out in January they're starting to see that phenomenon as well.
So what does that mean in terms of who the winners are? The grocery stores writ large, or are there certain players who are going to do better?
So far, it's been the discounters and the club stores. I'd put Walmart, Costco in those buckets. Also as genres of stores that sell value. If you see the market share move, it's pretty much Walmart, Costco. You see the hard discounters. The grocery stores, the ones that are public, they're sort of in the middle of the pack. So you're not seeing market share gains there. You're seeing stable trends, but it seems like the customer is moving towards value. I would say Walmart in particular, mid-single-digit grocery sales. The industry has called it flat to down. That's some big market share from the largest market share holder of grocery sales in the entire country.
Wow. So Walmart is your top pick out of that?
Walmart of the grocers is, and that's beyond a grocery call. It's about them being able to grow their earnings a little bit faster through alternative revenue. And there is that defensiveness in the grocery side of the story.